Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Life Liberated podcast. Now, on to the show.
Hello and welcome to Life Liberated with the team from Centura Wealth Advisory. Joining me now is Sean Clark. Sean, how you doing?
Doing very well today, RJ. Thank you.
Excellent. What is today's topic?
Well, what we're going to be talking about today is producing tax alpha through what's called direct indexing. So we're going to be talking about investing in stocks and how to produce tax alpha while doing that. So we'll talk about that. We'll talk about how we incorporate it in our portfolios and how we went about kind of choosing a partner for this type of a strategy. So this is an investment related strategy. The audience that we'll be speaking to today is really ultra high net worth individuals, privately held business owners, and the advisors who serve those folks. So as always, this podcast is for informational purposes only. Nothing discussed today should be considered investment or tax advice. And additionally, past performance is not indicative of future results, and outcomes may vary based on several factors. So with the disclosures out of the way, let me introduce my guest today, our Chief Investment and Chief Compliance Officer, Chris Osmond. Chris, welcome.
Thanks, Sean.
Good to have you.
Happy to be here.
Yeah, here in San Diego, no less.
I know. It's good to be in town.
Perfect. Well, glad to have you here, especially for this topic. It's a slightly technical topic. It's a topic that we dug into from a due diligence standpoint on the investment committee and investment department, and it's something that we use readily with clients. So we're going to talk about all that kind of stuff today, and glad to have you here to join me.
All right, likewise.
So, Chris, why don't you just at a high level talk to our listeners about what's called direct indexing?
So ultimately, Centura, we subscribe to market efficiency. So what does that mean, right? You have active managers and passive managers. Active managers, they're trying to outperform an index, let's just say the S&P 500, by choosing stocks. So let's say Coke versus Pepsi, in, again, an attempt to outperform the S&P 500 on a consistent basis.
Okay, so they're actively trying to pick or choose a winner and get better performance versus the index by doing that.
Correct. Or trying to avoid the losers.
Okay.
Now, depending on what study you look at, a active manager trying to outperform the S&P 500, which is the most efficient market from an information perspective, underperforms 75 to 85% of the time.
Okay.
Now you can go buy a passive ETF for 2 to 5 basis points, or almost no cost, right? But if you go out and hire an active manager, it's going to cost you anywhere from maybe 0.25% up to maybe even 1%. So you're going to pay significantly more, but you're going to underperform 3 out of 4 years on a consistent basis. So I don't know, to us, that doesn't make a lot of sense.
No, most clients don't like that either.
So in those markets where there's a less of an information advantage, markets are more efficient, we like to be passive. So we're going to look to utilize passive index investments in those markets like US equity. So S&P 500 is a perfect example.
So we want to take the market exposure, get the returns of the market, but not try and pick and choose which stock's going to be a winner per se.
Correct.
Okay. Or a loser.
So now direct indexing to your question. So direct indexing takes that theory of getting broad market exposure, but rather than buying an ETF like the S&P 500, you're actually replicating the index exposures by owning the individual stocks.
Okay. And that's unique, right? There's we're going to talk about why do you want that? What are the benefits of doing it, right? But structurally, that's a different thing than an ETF. Correct. So for our listeners, we're going to be talking about direct indexing. The vehicle that we like to use for direct indexing is what's called a separately managed account. And that allows us to hold the individual stocks and do this type of investing.
Correct.
So talk to me about separately managed accounts. I know when I started in this business back in 2006, we were still selling mutual funds to get passive index exposure. And the problem with mutual funds is that they would generate some capital gains inside of them, and they'd spit those out to you, and you would get your returns haircutted basically by these capital gain distributions that you didn't even want. So 2008-9 came along and indexing became a little more popular, but ETFs kind of emerged as the way to do that passive investing because they didn't generate these capital gains underneath the hood. And ultimately, you could keep more of your return, right? Low cost. So since then, ETFs have been wildly popular, right? A lot of people love to do the index type investing through ETFs, and you can trade them, you can do all kinds of things. But nowadays, we don't like to use the ETFs as much and especially for this type of a strategy, we would prefer to use an SMA. So talk to me about an SMA and why that's preferred versus an ETF for this type of investing.
Yeah, no, great question. And as mentioned earlier, an SMA, separately managed account, relative to an ETF, you just own that ETF. The ETF itself owns every company in that index. So again, looking at the S&P 500, they own all 500 stocks there, but you just own the ETF. A separately managed account, you're going to own all those 500 stocks, right? Now, direct indexing is a little bit different, but just that's separately managed accounts.
Okay.
Direct indexing now may not own all 500 stocks.
Okay.
Right. Their goal is to really leverage the law of large numbers. So they are going to construct a separately managed account, so an account that will replicate the exposure in the index, right? So it may own 200 stocks of the S&P of the 500. They're going to have the same sector exposures from an allocation perspective and really try to replicate the risk and return of the selected index. Again, in this case, the S&P 500.
Okay.
Now, while we like that, because in an ETF, ultimately, yes, they're lower costs, they're more tax efficient, but the direct indexing is that on steroids. Right?
Okay.
We believe, and the optimal way to really optimize the tax benefit is to tax loss harvesting. This tax loss harvest. So you have a loss, you sell it, you capture that loss, and help offset either other income sources or other gains your portfolio may have experienced throughout the year. To optimize that, we believe you should be harvesting losses throughout the year. Now, an ETF, generally, you're only going to be able to harvest those losses at the end of the year. Usually it's once. And you may not even have the ability to harvest any losses. For instance, what if you bought the S&P 500 ETF at the beginning of the year? Well, it's up 22, 23% after the election reaction today. So not really an ability to harvest losses there.
Right.
Conversely, we own a subset of the index, each of those 200 companies. The odds are there's going to be some losers in the bunch. In fact, going back to December 31st of 86 through February 28th of 22, 65.5% of the stocks in the Russell 3000, so that's the whole US equity market, have underperformed the index. So there are a lot of opportunities to still participate in index returns, yet harvest losses, which net of tax should create a better outcome than just buying the ETF.
Okay. So, and just to help kind of clarify or re-summarize what you just said. So to get the risk and return of the S&P 500 as an example, we don't need to own all 500 stocks. We could own a smaller subset, call it 200. Because of the law of large numbers, we can get very close to what the actual risk or return of that index is, right? And by having 200 stocks invested, that creates another 300 that are kind of in this bank that we could go to, right? So give me an example of tax loss harvesting. You mentioned that, and you talked about dispersion in there, 65% of stocks actually down. So what is tax loss harvesting? And give me an example, kind of, if we have 200 stocks that we're invested in, and then we have another 300 we can choose from, how do we manage through that?
Right. So again, not all stocks are going to go up, and some are going to go down. So say we buy 2 stocks, right? We're going to put 50,000 in each, right? So we have 100,000 spread across 2 stocks, stock A, stock B. Let's fast forward, say 6 months. Stock A is now worth 60,000. It's gone up 10,000. Stock B has gone down 10,000. Your portfolio is still worth 100,000.
Yep.
However, stock B, you now have a $10,000 loss in that position. So what tax loss harvesting would do is, okay, we're going to sell stock B. we're going to capture that $10,000 loss. And now we're going to buy stock C, right? That has a similar profile from a sector standpoint, risk, whatever, in the portfolio, and our exposure remains constant, yet we capitalized and captured that $10,000 loss. Now, if you're in the top tax bracket, right, at 37%, you factor in the Medicare tax, let's call it 40% tax, right? So now you essentially just we're able to offset that capital, that I should say bank, almost $4,000 in tax liability or benefit. Right,
Okay.
From loss.
Yep.
And then tax loss harvesting just does that constantly as stocks continue to experience a loss, sold, replaced with another, and we just continue to bank these losses throughout the year.
Okay. And what I think is cool is how, within a given index, kind of to your point, even if the market's up 20%, there's a whole bunch of stocks that have gone down. Right. And so by being able to capture those losses and then send stock B in your example back to the bank, replace it with stock C, we now can kind of keep the overall portfolio or the attributes we were looking for, but we've got a little tax asset in our back pocket for when we need it.
Exactly.
Right. And that's the whole trick here. And so I've read a lot of publications on this. I've written a white paper on it. We've got white papers from our partners, but I think most of the literature is going to be somewhere between 0.5% to 2% per year in what's called tax alpha, or really tax savings, right? So that would be money that investors would otherwise be paying to taxes if they owned an ETF or if they didn't do this tax harvesting underneath the hood. So there's significant value to that. And if people are, funding new portfolios, you get even more of that kind of closer to the 2% of the tax alpha. So this is a strategy from a client perspective we really like to use for existing stock portfolios or even new cash-driven portfolios from stock sales or business sales where we're going to be deploying into stocks. This strategy can work really well and save you a couple of points per year on your returns.
Yep. And where you can get the most juice for your squeeze here with tax loss harvesting, that is in markets with a lot of volatility and investments with a lot of dispersion. So if again, comparing back to the ETF world, right? And you're looking at an ETF of the S&P 500 versus a direct indexing separately managed account of the S&P 500, you're getting the same volatility, but you have no dispersion of the underlying holdings because you have one holding, the ETF.
Mm-hmm.
Where direct indexing, you have the dispersion across 200 or more securities. So that increases the value or the juice, if you will, of the tax harvesting ability.
Okay. Another thing that pops out here, we're calling this direct indexing. You'd almost say, why don't we call this tax harvesting, right? But there's another attribute to this. So being able to own the individual stocks allows us to actually customize portfolios. So I know sitting with a lot of clients, folks have specific preferences that they might want to see in the portfolio. Sometimes it's, value-based preferences. Other times they might just want to avoid certain exposures. Maybe they have it in their portfolio already or something like that. But direct indexing allows us to actually pick and choose what kind of exposures we want or don't want in the portfolio. So Chris, talk to me a little bit about that aspect of it.
Yep. No, absolutely. That is a huge benefit, and there's tons of options for customization here. Right? One is just market exposure. So what index do we want to select to replicate and leverage to try and produce tax alpha, right? So that could be the S&P 500. It could be the Russell 3000, like we mentioned. Maybe it's international equities like the All Country World Index ex-US, right? Maybe it's a combination of two, Russell 3 and the All Country World Index, right? So that market exposure is one level of customization.
Okay.
Then there's the tax exposure. And by that, I mean the personal tax exposure. So taking an individual's tax bracket and rates into consideration, but then also their ability to be as aggressive or conservative with the realized taxation or, a tax budget, as we call it.
Yep.
Right. What is the level of tax liability they're comfortable paying?
Yep.
Now, the tighter that is, the more tracking error or a dispersion from the index. And so we may see a varied result in terms of both risk and return, in terms of outcome relative to the index. But we do have that ability.
And that's a cool thing. I know I work with a lot of clients to kind of determine, hey, you've got this portfolio, you've got gains that we want to recognize, right? Capital gains rates are at some of the lowest points they've ever been historically. So there's some, down the road, those may go higher, who knows? But people sometimes want to recognize capital gains, especially at those lower rates, right?
Absolutely.
15 up to 20%. And so recognizing a little bit each year can make sense, but recognizing too much can be punitive, right? So setting those parameters is important, and being able to build those into the portfolio and have the systems and tools to manage the portfolio to those specifications is really unique and really pretty badass in my opinion, because you can't do stuff like that with an ETF or other tools that are out there.
Yep. And I would agree completely. And there's additional customizations that we really like to leverage as well that I think are really unique. Right? Another one would be certain clients and investors may have value preferences, right? So we can put tilts or value-based alignment into our constituent, our portfolio, right? So maybe they want to exclude tobacco stocks. Maybe they want to exclude energy stocks. They want to, oil stocks. They want to focus on green energy. We can build those preferences and biases into the direct indexing separately managed account, right? Maybe they have exposure to the Meg 7, right? It's been running up. They had a great run. They want to get some diversification. So we have the ability to perhaps exclude those from the universe, or maybe you want a broader exposure because the S&P 500 is such a concentrated index with the top 10 making up over 35%. Very concentrated. So maybe we want to put a small size tilt on there. So we're going to get more allocation or a broader exposure to more companies in a more meaningful way and get a smaller allocation to those top 10. So a lot of ways we can customize this account and this structure and still achieve the tax goal that we're trying to.
Should probably call it custom indexing.
Right.
I mean, you can really, dial these things into exactly what you want. So as we work with you, we analyze your portfolio. We typically will work with clients to say, here's what you have. Here's your risk tolerance. Here's your goals and your needs and all that kind of stuff. And then we identify what percentage of their portfolio might be appropriate for equity investment. And for that equity investment, this is a strategy we really like for the reasons we described, but mostly it can be customized. And what I think I'll point out is where we use it for clients, because there's two aspects that we've kind of hit on: tax harvesting and then the customized kind of exposures in the portfolio. I think the customized exposures make sense if it's a retirement account or a non-retirement account, right? If you want to have those kinds of specific value-based biases or whatever it might be that you want to, specify for a custom index, that can be done in either environment, right? Tax harvesting, you already have a tax wrapper in retirement accounts, so you kind of lose the ability to take advantage of that. So we like to do the tax harvesting in non-retirement accounts, and that just that taxable environment is really where this thrives. And so what's kind of neat, and Chris, maybe talk to me a little bit more just about the breadth of the indexes, because we talked about where's the best place to do tax harvesting. It's in volatile indexes where there's dispersion, right? So perhaps somebody wants to be doing this in an area that's a little bit more volatile than they otherwise would feel comfortable building out exposures to or something.
Absolutely, which is why we primarily use this in equity, because equities are much more volatile over the long term. Now, obviously, bonds have been extremely volatile since 2022, but over the long term, equity markets are much more volatile. Again, that's where we're going to get the most benefit from the tax loss harvesting. Right. And again, going back to dispersion, if we select an index that has more constituents or companies, right, we have more opportunities to harvest losses. So one common thing that we do is we replicate our exposure in public markets because, we do manage some model strategies. So when we're going to use direct indexing, we may often say, well, we're going to do 80% in the Russell 3000. So that's going to be all the US equities. 3,000 companies, right? So then we're going to have a larger subset to replicate that index. And then we may pair that with, say, 20% in the All Country World Index, ex-US. So a lot of companies in there as well. Again, just a larger subset, more opportunity for more dispersion, more opportunity for tax losses, and really, again, we more tax alpha benefit to clients.
Let's talk about another way I like to use it with clients. That's for folks who are anticipating a liquidity event or a disposition event in the future, right? So selling stock or some sort of capital gain event, right? If you know you're going to have either one big year of that or maybe a series of years, and you have a portfolio of stocks that's really just being invested, you can use this strategy to basically start banking losses, and those can go right on your tax return and be carried forward to a point where you do get that big capital gain event. And then you can use these losses that you've harvested over the years to mitigate the tax at that point in time.
Right. No, that's a great point. And I'd also be curious, because I know we also do a lot of work for business executives. And business executives tend to have a lot of concentrated stock. So how have we used a strategy like direct indexing to help diversify and add value on a tax basis through direct indexing?
Yeah, well, so a few different ways. From a portfolio perspective, we like to use it to get diversification away from that concentration, right? So we'll kind of deal with the concentrated position in and of itself. Is there going to be some that we sell down? Is there going to be some we hold for the long term? Are we going to hedge some? Are we going to borrow against some? There's different ways we could deal with that position. But once we've dealt with that, usually we're getting to some measure of diversification from a portfolio perspective, right? And let's just keep it simple and say we want to stay in the world of stocks. Well, we can, whatever we come up with from a liquidity standpoint, by driving that to strategy like this, we can limit any exposure that would be redundant to what they already have, right? So they might have a financial sector stock or something like that. We can eliminate financial sector exposure. We can eliminate anything that has high correlation to that, and basically create a nice, well-diversified basket of equities that can complement that concentration that they have in their portfolio. And when we start looking at that at a higher level in aggregate, we can start managing, controlling, and basically working with the risk a little bit better. So that's how I like to use it, at least when we're talking there. But I think there's just so many use cases for it. It's just a really great way, in my opinion, to be investing in equities. And here in 2024, I think this is the way, especially for a passive type philosophy, but you want to still extract some alpha and some active components. It's active not in the selection of the securities, but active in the ongoing management of the tax. And you can control the exposures. I just think it's a really cool product for where we are in markets today, what some of the folks we work with believe in or need to build into their portfolio. And in my mind, it's just a great tool. So I know you and your team dug into this from a due diligence standpoint quite a bit last year, I think, is really when we went in there. So talk to me a little bit around the providers there, who we selected, how we ended up there with our partner, and why we kind of like them and how we work with them.
Yeah, no, great question. And if you've heard me on other podcasts, generally the alternative investment ones, you know that due diligence is at the core of what we do. It's really the foundation. Big nerds there.
You love that stuff.
Yes, I do. So we take pride in our due diligence process, and it does extend beyond the alternative and private markets, and definitely is present in the public markets. And while this is a, in quotes, passive investment, they're not all are created equal. While we talked about the evolution of investment structures and the rise of direct indexing, truth be told, it's been around for decades. It's just risen to prominence in the last 5, 7, 10 years, right?
And it's kind of at an institutional level, I think, in a lot of ways.
Correct.
Not necessarily at the retail or individual level as much.
Correct. Much higher minimums, like 10 million or higher, much larger.
Yeah.
And when looking back, while it's risen in prominence, that is, prompted a lot of new players into the market. But we wanted to really identify a manager that has a long track record. that's been through multiple cycles, right? Not just perhaps COVID, but extending beyond that to before the great financial crisis. So ultimately that did narrow our universe quite a bit. But we really wanted to be able to work with a partner that's been doing this for a long time, that we could test, we could dig into their algorithm, we could understand changes they've made over time from learning opportunities and things of that nature. So again, not all created equal. So we wanted to understand their process. Tax loss harvesting, some will go in and do it every day. Some will go in and do it once a month, once a quarter. With the partner we selected, they do it once a month, approximately once every 31 days. There's something with tax loss harvesting called a wash sale, which means if you sell a security at a loss and you buy it back within 31 days, the loss is negated and you can't capitalize on that to help offset other gains or other income. So they go in every 31 days, and they'll look for loss opportunities. Now, if the market environment is extremely volatile, such as the height of the pandemic volatility in March of 2020, they may have increased instances of tax loss harvesting that deviate from the once per month, right?
Gotcha.
But we like that approach. Very straightforward, makes sense. Algorithm makes sense with regards to that. And we can also customize some of that as well. I really like that. And when we look at the customization, that was really the partner we chose, second to none, in our opinion, when it comes to customization.
Okay.
So one, we talked about the institutional nature, the ability to enter at a lower price, minimum threshold. Love that aspect. Some of the newer players, may still have a $10 million minimum.
So we can get 250,000 is where investors can utilize this.
Correct. Right. And you can start capitalizing and getting that tax alpha. We also like the market exposure. We talked about this, right? And now we ended up selecting a period.
Okay.
Been doing it since for more than 22 years, right? And they are now owned by BlackRock. BlackRock is the world's largest asset manager and one of the largest index providers via ETFs.
So no shortage of opportunities.
Right. So almost any index you can think of, the odds are it's an option for us to choose.
That's cool.
So we love that ability to really customize the market exposure that we like. Then there's the tax management preferences that we talked about, from the personalized, tax budget to the personal tax rate. That's really beneficial. The value tilts that we can incorporate to ensure that there's value alignment in a client's investments if they so choose, if they have those preferences. Then there's the factor tilts that we really like, like that ability, again, if we need to, maybe that's a size tilt that we want smaller, like we mentioned earlier. So just a lot of customized options that we didn't find in a lot of other institutions that we looked at. And then lastly, kind of back to our investment philosophy that we talked about at the beginning, and that's really market efficiency and not overpaying for a solution. Right. And generally you're looking at a cost from 20 to 40 basis points, maybe even higher for a direct indexing solution on top of other fees. Right. And so we were able to negotiate a price of 20 basis points. And our clients are able to invest with Aperio in direct indexing for 20 basis points. So pretty low cost. For comparison purposes, if you go out and buy the iShares Russell 3000, so that ETF, that's the same ETF by the same owner, BlackRock, right? They own iShares. It would cost you 20 basis points. So we could then go buy the Russell 3000 index in direct indexing for 20 basis points. The break even from a tax alpha to offset the cost is zero. Right. So now every point that we earn from a tax alpha directly goes to the client's bottom line. We really like that, particularly given the breadth of market exposure we can choose from.
And I think just to kind of, close it out, I think this is really important because meeting with clients, there's a lot of this kind of buzz and marketing and other things out there. And I've had clients say, well, I could, do this myself somewhere else, or I could take my exposure and I could create a custom exposure using ETFs or doing this or whatever. And at the end of the day, all the customized aspects of what you just described all the different ways that you can really get in there and craft it, as well as the methodology and frequency of which they're doing the tax harvesting. To your point or comment earlier, these aren't all created equal, right? There's a big difference between doing it well and just doing it, right? And I think we've selected a partner who has a long track record of doing it well. And I think when clients hire us for this type of a thing, they're paying us to basically bring them solutions that are efficient, that are able to deliver on what they want to do, that are heavily researched and vetted. And I think that's what we have here. So I really love using this solution for clients where it's appropriate. And there's just so many use cases where it could be applicable. So as you mentioned, we've got low costs with Aperio. We've got $250,000 minimum. So if anybody thinks that they could benefit from this in the portfolio, let us know. We'd be happy to help you. So Chris, I think in closing, we've covered all the major points that I wanted to hit on and to kind of convey to our listeners what this is, how we use it, what some of the key and cool points are. Is there anything else you'd like to leave our listeners with before we sign off here?
Not that I can think of. Just, I think that just know that we take our fiduciary responsibility very seriously, and we consider ourselves stewards of our clients' wealth. And again, we take that extremely serious, and we put a lot of care and caution into every investment that we ultimately approve, and research and diligence. And we want to know everything about those investments. So one of my core tenets of investing is you don't invest in something you don't understand. And so we want to understand every aspect of an investment, what those outcomes are, what could go wrong, how could it go wrong, how can we mitigate that, right? And so I would just leave with those parting words that we take the stewardship of our clients' assets with the utmost responsibility and care.
Very well said. Thank you, Chris. Thanks for coming on here today, discussing this somewhat complicated topic. It's got some technical components in that, but at the end of the day, helps clients get invested and keep more money in their pocket, I think is the main point. So for all of those who've listened to us this whole way, thank you for hanging on here. And if we can help you out in any way, let us know. Otherwise, RJ, we'll send it back to you.
All right, sounds good. But before you guys go, Sean, we'll go with you first. How can people contact you?
Our website's the best way, centurawealth.com. We've got all of our contact information on there, as well as other podcasts and resources. So head over to our website, check us out. You can see our photos, all that kind of stuff.
Okay, and that's the same for Chris?
That is correct.
All right. Excellent. Thank you, gentlemen. Sounded great. And most importantly, thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory, Centura, is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.